boy do I have some huge news for you today on exactly what is happening in the housing market. We have just got some new breaking news on what's happening with mortgage rates, with what's happening with home sales, and people, I think the opportunity for you to finally buy that home or for you to finally buy your first investment property could be coming. Because we all know over the past year, the housing market has been going absolutely crazy, up 19% year over year. We've seen huge amounts of FOMO in the housing market, people paying huge amounts above asking price. We've been seeing hedge funds coming in and buying up entire neighborhoods, and first-time buyers are feeling hopeless. So everyone, what does this news really mean for the housing market? Will house prices begin to fall soon, or will they keep rising? Let's have a look. Okay, first things first is this, everyone. This is big news. Mortgage rates are absolutely soaring. Look at this. Mortgage rates soar close to 5% in its second huge jump this week. So this is huge, everyone. Nobody in the housing market or these housing economists were predicting interest rates to go above 5% this early. And what you have to know, what's been behind this surging housing market is low interest rates and cheap debt. So investors could get interest rates at around 2.7 or 2.8, 2.9% at the lows during 2020 and early 2021. And they said, you know what, this is pretty much free money. So they're going to take this, they're going to invest it in housing, and it's also a way to hedge against inflation because inflation devalues the debt. But with home values so high and with the cost of borrowing going up, and if that cost of borrowing keeps going up to say 6% and inflation does start to come down later this year, well then these interest rates aren't looking so attractive anymore. You're probably also wanting to know, what interest rate do we need to hit for house prices to begin to fall? Well, the best way for us to have an idea of what may happen in the future is to have a look at history. Let's hit the charts, everyone. Okay, everyone, this is a chart of the 30-year fixed rate mortgage. And the last time we really started to see house prices fall in any meaningful way, the most recent time, was in 2018 when the Federal Reserve lifted the federal funds rate to 2.25%. Now, what did interest rates hit in 2018 at their peak? Well, look at this on the chart here, everyone. They hit around 5%. So we can see here when home values are overstretched and when interest rates start to hit 5%, that is bad news for home prices. The average rate on a 30-year fixed rate mortgage shot significantly higher Friday, rising 24 basis points to 4.95%, according to Mortgage News Daily. The quicker than expected rise in rates was weighed on demand for mortgages and refinancing loans. And another reason why mortgage rates are skyrocketing is because the Federal Reserve is no longer buying US Treasuries and mortgage-backed securities. That is something we've been discussing on the channel will happen once they finally step out, take all this stimulus away. It's only when the stimulus is taken away we'll start to see what is the free market fundamentals without manipulation. Now, what most real estate experts will tell you is for every 1% increase in interest rates, house prices can drop, or for example, borrowing power can be reduced by 10%. Now, I've gone over this many times in my videos, but say for example, if house prices were going to go up 10%, well then maybe house prices won't fall 10%, but instead of going up 10%, they'll just stay flat. Now, just another disclaimer, the housing market in the US, it's not just one market, okay? There's many states, there's many cities, and even suburbs down to the granular level. On the suburb level, every housing market is different. So why one housing market may be booming, there could be other areas that are falling. So even though I'm giving you this information here in this video, you really have to do your research on the specific location you're looking at buying, because I can't go over every suburb in the US in this video. But look what's happening now, everyone, and this is going to have big consequences for the housing market. With both rates and prices considerably higher, the median mortgage payment is now 20% more than a year ago. That is absolutely crazy, everyone. And of course, the Federal Reserve won't include this in the CPI. Mortgage costs and borrowing costs absolutely skyrocketing, and simply it'll get to a point where not only home buyers can't afford it, but investors, they're going to say, look, we're not going to get the return we think on this capital, and borrowing costs are getting too high, and you'll have investors start to leave the housing market as well. And you may think, well, BlackRock will come in and buy up all the homes. Well, again, the same thing for them, everyone. What do they need? They need returns for their investors. And if they think home prices could fall from higher borrowing costs, then they may start to step out of the market or start slowing their acquisitions. And if you want to have an idea with what would happen with mortgage rates in the future, you have to pay attention what's happening with the 10-year US Treasury yield. And people, today, the 10-year absolutely skyrocketed. Look at this, everyone. The 10-year right now, as we're recording this, is 2.479%. And if we have a look back at history, when the Federal Reserve lifted interest rates to 2.25%, the 10-year hit a high of 3.05%. So what is the bond market telling us? The 10-year is almost at the level it was in 2018 when the federal funds rate was already at 2%. So I think the bond market and bond investors are betting that the Federal Reserve is going to go much higher than 2% interest rates, maybe to 3%. And they could also be pricing in the Federal Reserve about to start dumping US Treasuries on the market, and they're not going to want to get into the market until they have certainty on how much assets the Federal Reserve will sell. But it's not only mortgage rates going up that is a headwind for the housing market. Also, home sales are falling month over month. Look at this, everyone. Pending home sales sink in February, setting a grim tone as the housing market enters key spring season. Setting a soft tone for usually busy spring season, pending home sales, which measures signed contracts on existing homes, fell 4.1% in February compared with January. So we're going to see demand go down. But what we also need for house prices to start going down is we need supply to start going up, because it's been record low inventory. It's been this low supply that has caused this FOMO and these crazy house prices, because with there not being much homes on the market, buyers are having to bid against each other to secure that property. So again, let's see how much supply we need to see for house prices to start falling. Well, again, we'll bring up the chart here. This is the monthly supply of homes in the US. Now, again, when house prices began to fall in 2018, and I'm talking specifically about the New York, California areas, not all areas were falling. Let's have a look to see what inventory went up to. We can see here that housing supply went up to about 7.5 months worth of supply for there to be house prices falling. And we can see here in 2008, if you really want a housing market crash, you need about over 12 months worth of supply on the housing market, like what we saw in 2008 to cause a really big crash. But right now, we can see here in 2020, inventory did hit a historic low of only 3.5 months worth of supply. That's when we really saw house prices skyrocketing and with interest rates at record low. But we can see the trend, it is starting to increase. Went up to about 7 months in October, but then it's dropped, but it's now on the rise again. So again, people, we need that to go over 7.5 months worth of supply for us to start seeing cooling in the housing market. So this is the 4th straight month of declines in pending sales, which are an indicator of future closings on 1 to 2 months out. But these rising mortgage payments couldn't come at a worse time, because already people's grocery bills are going up, and people's fuel and gas prices are going up, and people's energy costs are going up. So they're going to have less money in their budgets to spend on their mortgage payment. Buyers are already facing inflation on everything else in their budgets, which exacerbates the affordability issue. Rents are also surging higher at a record rate, causing more potential buyers to be unable to put aside money for a down payment. In addition, as rates rise, some buyers will no longer qualify for a mortgage. Lenders have been much more strict about how much debt a borrower may take in relation to their income. Yes, I'm definitely starting to see this with the banks. They're being very conservative with their valuations, and they're being very picky with who they lend to. I guess they learned their lesson from 2008, and they probably know that home prices are extremely overvalued, and they don't want people to be taking on too much debt right now. And it's going to be very interesting how the housing market performs in the normally strong spring selling season. But I know what you're thinking, okay, what does all this mean for me in simple terms? What this means, everyone, we're going to see weaker demand from higher borrowing costs. But what has caused this crazy housing boom is low supply. So what we need is weaker demand and higher supply for house prices to begin to fall. Now, with the housing market, it's not like the stock market. It is very slow to react, and is very slow for buyer sentiment to begin to change. So I don't expect house prices to begin falling anytime soon. But once we start to get some data, maybe in a month or two, on how these high borrowing costs are starting to affect our home buyer sentiment, once we see that FOMO being taken out of the market, and once investment starts to change to more worried about prices going down and people saying, look, maybe I'll hold off and see if prices go lower, that's when we'll really begin to see the housing market shift. But again, everyone, I just want to reiterate, this is not me predicting a catastrophic imminent housing market crash, but it is me saying that things are definitely going to change from bullish to more bearish for the housing market if these borrowing costs continue to rise. And for us to see significant declines in the housing market, we're going to need mortgage rates to start going above 6%. But we have to look at both sides of the story. If supply does not increase, and if the Federal Reserve all of a sudden does a U-turn, if the 10-year US Treasury yields start to plummet because of any fears or any risk-off environment in the markets, we could start to see mortgage rates fall again, and we could just possibly see home price appreciation moderate. Now, as a quick message to my loyal viewers and subscribers, I want to say thank you so much for your support on yesterday's video. It was really overwhelming and brought a tear to my eye yesterday. about how so many of you, my subscribers, care about me, care about the content I'm creating. I received dozens and dozens of emails from you guys. So again, from the bottom of my heart, thank you. And of course, I'll see you all in the next video.